Hello everyone, thanks for checking out my video. Ladies and gentlemen, I would like to share that I have received my first ever paycheck from YouTube. It's a very small amount, and that's like after doing this YouTube thingy for about 2 years, 7 months and 5 days. And guess what I did with the money? Well, I will share more in this video. Anyway, the US stock market ended a rough and volatile week on a brighter note as all three major indexes rallied more than 1% last Friday. But that said, the S&P 500 still declined 0.8% for the week, and the Nasdaq dropped 2.1%. Both indexes posted back-to-back weekly losses for the first time since April this year. With 4 more Magnificent 7 tech companies reporting this week, things will only get even more volatile from here. Meanwhile, I have lots of stuff to share for my options trades this week, so do stay throughout the video to find out more. Okay, last week was a turbulent week. On 24th July Wednesday, we saw S&P 500 and Nasdaq tumbled for the worst day since 2022 after Tesla and Google reported their earnings. But on Friday, most stocks rebounded. The recovery could be due to the release of a big data point, the PCE index, which supported the narrative of a resilient economy and gradually cooling inflation. Core PCE, which excludes the cost of food and energy, came in slightly higher than expectations but rose at its slower pace in over 3 years. The other readings came in line with analysts' estimates. These so-called positive inflation numbers has given investors more confidence that the Fed will likely cut rates in September. Some are even expecting 3 rate cuts this year, with the other 2 coming in November and December. Overall, last week's market movement continued to show that investors are still pivoting into small cap companies, with the Russell 2000 rising 3% for the week. Alright, the final week of July has a lot in store for investors. This week, we have the FOMC meeting taking place on 30th and 31st July, and it will definitely be closely watched by the investors. The Federal Reserve is widely expected to keep interest rates unchanged. Therefore, the market will be more interested in what Jerome Powell has to say. Will he set the stage for a rate cut in September? We shall see. This coming week is also a crucial week of earnings reports as we have lots of big tech companies reporting. The 4 Magnificent 7 tech giants, Apple, Microsoft, Amazon and Meta will be the headliners. But they will be joined by other big firms such as ExxonMobil, AMD, Coinbase, Starbucks and McDonald's. In case you weren't aware, Tesla's quarterly earnings was disappointing and Google's results failed to impress investors. So I think the other 4 Mag 7 will need really impressive performances to renew the excitement about AI and to reignite investors' enthusiasm. Finally, on Friday, Wall Street will be zooming in on the July jobs report following a surprisingly strong Q2 GDP. Economists believe that this report could determine whether a September rate cut will happen. Just to share, we had 2 straight months of rising unemployment, which perhaps suggests that there is an economic slowdown due to the high interest rate environment. Therefore, there are investors who think that the Fed might have to cut rates sooner to prevent further economic decline. Moving over to the technical analysis portion. Okay, some changes to this segment moving forward as I have received requests from viewers to cover Nvidia, and so I have added that in. But as a result, I have removed SPY from this TA section, otherwise the video will be very long. Just to add, I have also included Meta and Microsoft in recent 2 months due to viewers' requests. So with this, I will be covering 6 companies out of the Magnificent 7, and coincidentally, I do own all of these Mag 7 shares except for Amazon. Okay, let's begin things off with Apple. Apple's short-term trend is bearish, as you can see that in terms of price action, it has been creating lower highs since it reached its peak about 2 weeks ago. To add on, it had 9 red candles in the last 10 trading days. Right now, it is sitting at the critical 61.8 Fibonacci level at around 218. Apple will be reporting its earnings on Thursday, 1st of August, so watch this 218 level very carefully. To be very honest, I am not too confident about Apple's results, and if it really disappoints, this 218 will break. Not trying to scare you, but if Apple cannot reclaim this 218 level, there is a high probability that Apple will fall towards 206, if not at least 210, where the 50 moving average is. By the way, in case you're not aware, this is Apple and not Tesla. In Tesla's context, an $8 drop from 218 to 210 may mean nothing, but for Apple, this 3.6% drop would mean a wipeout of more than $100 billion of market cap. All that said, we know sometimes the market can react quite unexpectedly to earnings, so if somehow the market likes Apple's performances, just watch for two things. First of all, look out for that 218 level. Apple needs to reclaim that. Secondly, watch that blue downtrend line. Apple needs to break above it decisively, which means at least 2 green candles above it. From there, it may retrace to retest the blue trend line, or it may not, we don't know, but a clear breakout from the 61.8 Fibonacci level, and that blue trend line would mean we have a high chance of hitting 225 at least. Again, to put things in perspective, from 218 to 225, a $7 increase means 3.2% gain, and that's more than $100 billion in market cap. Anyway, above 225, I think Apple will just slowly grind up towards the tiny gap between 231 and 232. Next up, let's look at Tesla. Just like Apple, Tesla is also on a short-term downtrend, marked by that blue trend line. It did attempt to break above the trend line one day before it reported its earnings, but unfortunately, the earnings was disappointing, and Tesla gapped down and plummeted 12% in one day. During that day, it almost filled that earlier gap up, and for the last 2 trading days, it seems like sellers have dried up a little bit. That's slightly positive, but it's not a sign of a reversal yet. For a reversal to happen, for Tesla to regain its bullish momentum, there are a couple of things to watch. First of all, it's this super long-term purple trend line. Secondly, watch the short-term blue downtrend line. Tesla needs to get above these 2 trend lines with decent volume to show that buyers are coming back. If it can do that, it is slightly bullish only. For me to say that Tesla is really bullish, it needs to fill this big gap between 226 and 245 without getting rejected. If that happens, then it will open the door towards 260's range at least. On the other hand, if last Thursday and Friday movement was a dead cat bounce from the 12% sell-off, then we can expect Tesla to hit 206 this week. This level is really important. I repeat, this level is critical. Not only because it is the all-important 61.8 Fibonacci level, this is also where both the 50 and 200 moving averages are, at around 204. So in short, watch this 204 to 206 area closely this week if Tesla continues to fall. Because if we were to go below this area, it's very bearish, and I would say it's very likely Tesla will go below 200 again. And below 200, it also means there is a decent possibility that we will hit back to the earlier mini consolidation area at around 180's range. Alright, as shared at the start of the video, YouTube has finally paid me as I received my first ever paycheck last week. The total amount is $172.90, all thanks to your super thanks donation and some AdSense revenue. So what did I do with the money? Well, I donated it all away. I basically donated $50 each for 4 charity organizations, and they are Shine Children and Youth Services, an organization that empowers disadvantaged children and youth through research-based social work and educational psychological programs. Next is the Lions Befrienders Service Association, a voluntary welfare organization that provides care and support to help seniors age healthily and to enjoy purposeful and meaningful lives. The third organization is SPCA, which is a non-profit animal welfare charity. Their 2 main objectives are to promote kindness and prevent cruelty to animals. And last but not least, Singapore Cancer Society, a self-funded social service agency which provides an integrated care from cancer control and prevention to patient support and care services. By the way, all these are not sponsored posts, they don't sponsor me. I chose these 4 organizations because it covers the children, the youth, the elderly and the people with illness, specifically cancer, which is one of the leading causes of death in Singapore, and the treatment is so expensive. And of course, not forgetting the animals. While $50 for each organization might not seem like a lot, but I do think every little bit adds up and can make a real difference. More importantly, this money are from you guys, the viewers who have contributed by sending me super thanks or for watching my videos. Alright, back to business. Let's now have a look at Google's chart. Wow, 10 red candles out of 12 trading days. I don't think you need me to tell you that Google is also bearish in the short term. What makes it even more bearish is that it fell out of this long-term uptrend channel with solid red candles. Perhaps what had confused investors is that Google's earnings was pretty decent, but why the sell-off? Well, I think maybe too much expectations have been built into the share price, as Google has rallied more than 40% since March this year. Anyway, given that the fundamentals are still strong, this sell-off presents an opportunity. I myself is trying to see how I can snap up some shares. It's almost reaching my buy point. Okay, for this week, watch for the level 162. This is a level that held pretty well since that huge gap up back in April. This level has to hold. If it breaks, I think we could see the gap being filled, which means Google may fall towards 156 or 155. This is one area which I may consider picking up some shares. The last line of defense lies at the 200 moving average, which is around 152. If this gets breached, then the odds of filling the second gap at 143 to 145 will increase. On the other hand, if Google wants to resume its uptrend, very simple, get back into that uptrend channel and reclaim the 50 moving average at around 178. If it can fill that gap down between 176 to 181 and not get rejected, it's even more bullish. Anyway, just a small piece of good news for the bulls. Google's last Friday's candle has fallen completely out of the Bollinger Band. So that means early this week, say Monday and Tuesday, Google may just chop around the current 160 range and unlikely to go below 160. Well, I could be wrong. As for the later half of the week, whether it continues to fall or rise, it's difficult to say, but I do think fellow advertising firm Meta's earnings on Wednesday 31st July could affect Google's stock price. Let's now move over to Meta, who is reporting its earnings on 31st July as mentioned earlier. Meta's chart looks interesting to me. So in my last video, I mentioned that if Meta couldn't get above 488, we may see 460s and 450s range again. Guess what? Meta tested and attempted to close above 488 early last week, failed to do so, and went towards 460s and 450s. Okay, here's why I think Meta looks interesting. If I were to zoom out the chart, it looks like a big bullish inverse head and shoulder pattern. To add on, the bears tried to bring Meta below 454 last Thursday during intraday, but Meta managed to recover in time at the end of the trading session. But before you get all too excited about the upside, I must say the bullish inverse head and shoulder pattern has not been confirmed yet. For it to play out, there's one important level to watch, a level that I mentioned earlier, and that is 488. By going above 488, it means Meta would have reclaimed the 61.8 Fibonacci level, the 50 and 100 moving averages, as well as fill the gap between 476 and 487. And above 488, it has a high probability to charge towards 500 at least. For a full-blown bullish momentum, Meta has to get above 521, which is the neckline of the inverse head and shoulder pattern. If that happens, we can say hello to new all-time high. On the other hand, in terms of the downside, watch for 454. This is a level that Meta has bounced off a couple of times previously. If this breaks, the last line of defense is the 200 moving average at 429. If this moving average also gets breached, I would think we will hit towards low 400s, basically towards the gap area between 399 to 414. Moving over to Microsoft. Wow, Microsoft chart isn't looking that great as it has fallen below the 61.8 Fibonacci retracement level and lost the 50 and 100 moving averages. If its upcoming earnings on 30th July doesn't impress investors, I believe Microsoft could easily head towards low 400, with the 200 moving average acting as a support. After which, pay special attention to 389. If this support doesn't hold, I don't see much support below all the way till 370's range. At this point, I cannot imagine Microsoft falling to this level, but if it does, I will be happy to pick up some shares. In terms of the upside, Microsoft needs to reclaim the 61.8 Fibonacci level ASAP, which is around 429. If the earnings is good and if we reclaim this 429 level with volume, I think there is no issue for Microsoft to continue its way up to 436 to 444 range, where the 50 moving average and that tiny little gap are. If we ever get above 444 this or next week, there is then a pretty high chance for Microsoft to continue moving towards 453. Okay, last but not least, new addition to the technical analysis lineup, Nvidia. Just like Google, Nvidia saw 10 red candles out of the last 12 trading days. That's obviously bearish. Though the company only reports its earnings towards the end of August, this week's earnings from AMD could potentially affect the sentiment of Nvidia's share price. Therefore, expect some volatility this week, alright? For the downside, watch for the level 100, where the 61.8 Fibonacci retracement level is. This is also a psychological support level, but given how volatile Nvidia stock can be, you might want to give a bit more buffer and include that gap area between 96 to 101 as a support zone too. Nvidia needs to bounce off this area. If it doesn't, I do think we could see Nvidia in the 80s range again. And I'm just thinking ahead, whether is it this week or in the weeks to come, if somehow market sentiment turns sour or the chips industry faces some pressure, or if Nvidia earnings disappoint, I do think we may go as low as 76 to 78 area. If we ever hit this area, that's a more than 30% drop from current price and a 45% drop from its all-time high of 140. But just to clarify, I am not saying it will definitely happen. I'm just mentally preparing you how much such high growth stock can fall in the event of poor earnings or simply because market makers want to dump shares. But of course, if the AI growth story continues and Nvidia continues to impress investors through their earnings call, then I think minimally Nvidia will reclaim the 50 moving average at around 119. Once Nvidia reclaims this moving average decisively with volume, I think the bulls can prepare to see more upside towards the 120s and 130s range. Okay, moving over to the options trading segment, quite a fair bit of things to update. First of all, I have two covered call contracts on Tesla expired last Friday 26 July. One was with a strike price of 200 while the other was 190. If you had followed me long enough, you would probably know that earlier half of this year, I got assigned twice for my cash secure put on Tesla. Basically, I had to buy 100 Tesla shares at 190 on 26 January and another 100 shares of Tesla at 190 on 18 April. At that point, Tesla was trading around 180s and 150s range respectively. To add on, one of the contracts was assigned on purpose, which means I wanted that assignment. During that period, there could be viewers who wondered why did I take on the assignment. It was so dangerous, Tesla might go to 120 or 100 etc. I did briefly explain the reason previously, but it could be difficult for viewers to understand at that point. But well, now I think it's easier to understand because I know Tesla will recover and also because I can milk premiums from these Tesla shares. This is called the options wheel strategy. If you don't know what this is, check out the video link at the top. Anyway, look at where Tesla is now. It has recovered from 150s and 180s range. Despite last week's 12% plunge in a single day, Tesla is still trading above $200 as of the date of recording. Since Tesla closed above both of my strike prices on expiration date, 200 of my Tesla shares will be caught away on Monday 29 July. Just to share, before these shares got caught away, I have sold multiple covered calls on the shares, which has earned me close to $6,000. Again, like I always said, this whole process is like the market makers parked the shares with me temporarily, paid me some rent, which is the premiums, and now I am returning the shares back to them. Next up, remember this covered call on Tesla? The strike price was $225 and expiration date was 16 August. This was the contract that I wanted to day trade on 2nd July, but I got stuck as I couldn't close it during the day. Then, the next thing we knew was that Tesla flew to 260's range. For more information on this trade, please check out the video link at the top. Anyway, I wanted to highlight that in that video, I mentioned that the plan was to hold on to the contract and do nothing. Reason being, at that point, the expiration date was about 1 month away, and I specifically mentioned that a lot of things can happen in a month. I also shared that I would want to see if Tesla will retrace back to 220's range in August. Well, Tesla is back in the 220's range before August. And so last Friday, when Tesla was falling during intraday, or specifically when it fell below 220, I took the chance to close the contract by buying it back. So the calculation is as such. I first sold the contract on 2nd July and received a premium of $1,960. Then on 26th July, I bought back the same contract by paying a premium of $750. So the net profit is about $1,200 after deducting the trading fees. Okay, moving on, the next trade is on Tesla again. It's this covered call that was sold on 24th July Wednesday, the day when Tesla plummeted 12%. The strike price was $225, expiring on 30th August. The reason for making this trade was because I was of the view that Tesla's bearish momentum could continue for a few days, and therefore I sold a covered call, which is a bearish move. But guess what? Tesla did not continue to fall the next day as it rebounded about 2%. However, I didn't panic because given Tesla's poor quarterly results, it was just a matter of time that it will fall again. And guess what again? The very next day, which was 26 July Friday, Tesla had a mini sell-off the moment the market opened, and it went as low as 215 to 216. And because Tesla's stock price is so erratic, I decided to close the position by buying back the contract to earn a small profit. So here's the calculation. I first received a premium of $1,300 for selling a covered call contract on 24th July, and then I bought back the same contract 2 days later on 26th July by paying $1,195, and that gave me a small profit of about $100 after deducting the trading fees. Together with the earlier Tesla trade that I had closed, the total profit for these two trades for last week was about $1,300. And if I were to add the profits from the first two Tesla covered call contracts, the profit would be at least $7,000. That's more than 9,000 Singapore dollars. Now you know why I love trading Tesla, mainly because of its volatility and how crazy the share price can move and swing. But all that said, if you are not familiar with options trading, please be very careful. Many investors have seen their accounts blew up because of options trading. I have some videos on basics of options trading, do check them out if you have time. Alright, the last option trade to update is this cash secured put on Nvidia. This contract was sold on 24th July Wednesday. The strike price is $90, expiring on 30th August. The rationale behind this trade is that Nvidia was falling for no reason on that day. I mean, we know that day turned out to be a tech sell-off, but a gap down plus 6% drop for nothing is a little overreaction here in my opinion. Nvidia will likely have a small bounce or go sideways. Anyway, I chose a strike price that gave me some buffer because you can see that I have multiple support levels above my strike price. First of all, the level 115 has proven to be a decent support as Nvidia bounced off this level on a few occasions. Secondly, 61.8 Fibonacci level has always been a crucial level, and that should offer some support at around 100. To add on, 100 is also a decent psychological support level. Then we have the 100 moving average floating at around 103, a level that Nvidia has not been trading below since November 2023. Last but not least, I have the gap between 96 and 100 acting as a support as well. But all in all, even if my strike price gets breached, I may not mind getting Nvidia shares at $90 per share. Alright, I know all these option trades that I am sharing are already so-called done deal. Some viewers may prefer live trade updates from me, but I just want to say that the objective of my sharing is that I hope you can learn something from my thought process, instead of following my live trades blindly, which can be very risky. Alright, the video is a little too long, so I will keep this portion short. This coming week is one huge week for the stock market, especially for the tech industry. With more than half of the Magnificent 7 reporting their earnings, and with 6 out of 7 of them would have reported their results by the end of the week, the top of mind for many investors is how these companies' tens of billions of dollars in AI investments are coming along, and how much of these expenses are turning into new business opportunities or new revenue streams. In short, the big tech earnings will test the limits of AI spending. Look at Tesla and Google. For Tesla, it's quite straightforward. Their AI and robotic stuff are not happening yet, and hence the market dumped their shares. But how about Google? They beat their top and bottom lines, so why are they down more than 7% last week? Well, we may never know the real reason behind the sell-off, but I think we can attribute some part of it to the high market expectations. It could be a case where investors have priced in too much and expecting too much. They want these heavy AI spendings to translate to solid results, but yet Google reported slowing ad growth. To add on, I believe Google's sell-off is a preview and warning for the other mega-cap tech giants that are reporting this week. The market wants more than good performance, and if you don't deliver, they can be merciless. Furthermore, with a September rate cut likely to happen, at least based on current expectations, the market may increasingly shift their money into smaller cap stocks if the big tech earnings fail to reignite enthusiasm for AI. On a side note, some investors may question whether the current pause in the tech and AI sectors marks a turning point in this bull run, or if it's just a typical pullback in a bull market. What do you think? Alright, that's all for this video. As usual, do help me with the like and subscribe buttons if you haven't. I will see you in the next video. Thank you.